compensation, there's this profit at all cost mentality led their banks off a cliff, putting the paychecks of small businesses and workers at risk. We heard over and over they just couldn't have known the Fed would raise interest rate, despite regulators and other banks and investors warning over and over about interest rate risk. They just couldn't have known. They couldn't have predicted the social media panic, despite knowing for years that their customer bases were concentrated and posed a risk. They just couldn't have known that growing so fast to grow their bonuses would put their banks at risk, despite repeated warnings. It was basically the dog ate my homework for 3 long hours. These bank executives failed at Banking 101. Their banks grew too fast. They doubled down on risky bets and riskier lines of business, never stopping to worry about whether their decisions made any sense as long as the profits kept going up and up and up. This spring, those bad decisions finally caught up with them, though not before they tried, as we all know, to cash out. Just a few years earlier, they complained about supposed regulatory burden that they felt was unfairly foisted upon them. In 2015, Silicon Valley Bank CEO Greg Becker said, quote, "Because SVB's business model and risk profile do not pose systemic risk, imposing the numerous Dodd-Frank requirements that were designed for the largest bank holding largest bank holding companies would place an outsized burden on us with minimal corresponding regulatory benefit." 3 years later, Signature Bank co-founder Scott Shea, raising the stakes on Becker's comments, said, "We find it ridiculous and unacceptable that by virtue of growing one day past $50 billion, we'll be burdened with rules intended for the mega too big to fail banks. We strongly believe we're not even in the same zip code as being systemically important to the U.S., to New York, even to Midtown Manhattan." Turns out they were both very, very wrong. On Tuesday, we also heard a lot of blame placed on regulators. We know that regulators warned these banks over and over there were glaring risks on their balance sheets. It's fair to say, though, that regulators should have been tougher and stronger. They should have, as Senator Tester said in this hearing 2 days ago, they should have dropped the hammer. But let's think about why the hammer didn't come down so hard. The strongest hammers were taken out of their toolbox. It's not a coincidence that both banks' rapid growth started in 2019, right after the Trump bank regulators rolled back rules for banks of that size. Bankers like Greg Becker and Scott Shea and their lobbyists begged for weaker rules, begged for lax oversight. And lo and behold, weaker rules and lax oversight are what they got. The former FDIC chair said that if bankers feel examiners are overstepping their authority, quote, "let us know." The former acting controller said the OCC is trying to improve its, quote, "responsiveness to our customers," which are the banks. Think about that. The regulator in charge said the banks are their customer. We're all friends here. That was the mentality. It was the weaker rules on the books, and it was the culture they created in the top and allowed to fester. Former vice chair of supervision said, Vice Chair Barr's predecessor said, "Markets are always ahead of the regulators. Frankly, that's how it should be. It's analogous to the advice that my father provided me, that if you don't miss at least 2 or 3 planes a year, you're spending too much time in airports." He continues, "If the regulators aren't a little behind the market in a few areas of any given time, they would be stifling innovation and evolution." In other words, it's better to let wealthy Wall Street profiteers go unchecked because they might figure out another creative way to boost their stock prices and pad their pockets. Regulators they didn't just miss the plane, they allowed a couple of plane crashes. Let's be clear, banks are not regulators' customers. They're not your friends, they're not your clients. Regulators serve the public, or at least they should. You are the ones who are supposed to police these powerful banks and give people peace of mind that their money is indeed safe. The purpose of these hearings isn't just to place blame, it's to actually fix what went wrong. We need to undo the damage the last administration did as they weakened rules and preached about it, I might add. We need to strengthen our guardrails like capital and liquidity and stress tests. We need to address some of the issues that regulators have identified in their reviews on the failed banks, like staffing, which is a result of years of budget cuts and shifting priorities under the former administration. The examiners and regulators need to have the tools and the resources and the support they need to protect the public. We need to consider options for deposit insurance reform to protect stabilities in consumers and small businesses. We need to improve our merger policy so that failed bank acquisitions by mega banks are only a last resort. We need to restore the culture of supervision that puts the public interest ahead of bank executives' stock portfolios. Of course, it's good for our economies and our economy and our communities and the public when we have successful banks. No one disagrees with that, of course. What we have seen in too many cases, though, isn't just banks being successful, banks turning a reasonable profit. SVB and Signature's profits soared, and so did their executive compensation, always linked in these banks, as they push for even more uncontrolled growth. Profits can't come at the expense of everything else. Regulators, you can't allow them to. Banks must be well managed and resilient and put their customers first. We must hold everyone responsible for these failures accountable. At the top of that list must be the CEOs and executives who ignored warnings and ran their banks into the ground. I'm working with members of this committee in both parties. I hope there will be bipartisan support on legislation to strengthen your ability to hold bank executives accountable for their wrongdoing. I want to see meaningful punishment and deterrence, not just slaps on the wrist or paltry fines, barely a speed bump in their race for profits. I urge you to use your authority to protect the public and the many bank and credit union executives out there who are doing right by their customers. That's most of them, of course, by holding failed bank executives accountable for their failure, for their greed and incompetence. Our witnesses all know you work for the American people. I look forward to hearing how we can strengthen financial stability, stay ahead of risk, protect workers, families, and small businesses that power our economy. Senator Scott.
Thank you, Mr. Chairman. Today's hearing is about regulatory supervision and congressional oversight, something that we all take very seriously. I hear a lot from my friends on the left that this is somehow a legislative failure, that you didn't have the power needed to supervise the banks. There's nothing further from the truth than that concept, that you did not have the legislative power necessary to do your jobs. That's just false. We can point to S-2155 all day long, but if you read S-2155, you come to the conclusion that the supervisors had the ability to enforce a regulatory regime to keep America's financial institutions safe. You did not use the tools in the toolbox to do the job that was necessary. People at home take this opportunity to view the 6 alphabet soup agencies and try to figure out what we're here talking about. We're talking about the safety and the security of the greatest financial system in all of the world. For the average viewer at home, they're asking real questions about, is the system safe for me? For those who are unbanked or underbanked, who have challenges having confidence in the banking system, this is a challenging day. For those who want to have more confidence in the system that they've never had confidence in before, this is a serious day. For those who look at this situation and ask themselves, why do they have to pay higher interest rates or higher fees on products from banks because bank execs didn't do their jobs and regulators weren't paying attention? So far, we have no answers. Each of you are working on broad proposals and regulations that will affect our financial institutions, and I expect we'll hear a lot about that today. But what I'm concerned about is that we won't really get to the fundamental question about why, when you had an opportunity to do the job assigned to you, it just wasn't done. When we look at the failures of both Silicon Valley Bank and Signature Bank, we come to a couple of conclusions. And I've said this a few times before, but I think it bears repeating. That the situation that we saw that led to 2 of the largest bank failures in American history were caused by three things: bank mismanagement, supervisory failure, and soaring inflation caused by the Biden administration. Today, we're here to focus on the supervisory failures. From the beginning, regulators called these failures idiosyncratic events. This implies that they just popped up out of nowhere, like mushrooms after a rainstorm, that there's no way in the world you could have forecasted what was going to happen. But after listening to the CEOs on Tuesday, the one thing we walk away with from Signature's CEO, Mr. Becker, is that for 20 years, they had the same business model that had over 80% of their deposits uninsured. 2 decades, the deposits were uninsured over 80%. That is not idiosyncratic to me. It seems pretty much like the norm. We also heard from Mr. Becker that the flashing lights, the warning lights, had been going off since the first quarter of 2022. That's a long time before March 9th of 2023. And then your reports reinforce the fact that the warning lights were going off well before the first quarter of 2022. You all have failed, many of you have failed the American people. Failed the American people in keeping their confidence high in our financial system. I want that to sink in. You get to come to Congress. You spend 5 minutes answering questions from each one of us with the ability to play dodgeball for those 5 minutes. And then you go back to your respective agencies and you hold no one accountable. Even though your reports say that there was failure within your midst, failures within your agencies, and yet not a single employee or yourselves are held responsible. Mr. Barr, it seems like, as we talked about last time you were here, about the reports that were going to come out on May 1st and what it would find. The one thing that's clear is found that the Federal Reserve didn't do their job. And yet, here we sit again. Your report says you acknowledge that the supervisors of the Federal Reserve failed to act swiftly and do their jobs, but in the next breath, you point the blame at Congress and S-2155. And I read through the legislation just to make sure that I did not misunderstand what part of the legislation withdrew your ability to provide the supervisory responsibilities. I couldn't find it because it's not there. I find it ironic that the ultimate takeaway was ask for more authority, not less, more authority, as if somehow it was stripped away. And it simply was not. But that to me is exactly what happens in Washington when something bad happens. No one takes responsibility, and we take more authority in the regulatory framework of this country. And what happens when we take more authority in the regulatory framework of the country, Mike, you know, and I certainly know it as a small business owner, the more capital that you push to the sidelines in hopes of solving a problem that had to do with liquidity and not capital, you actually rob small business owners, women small business owners, minority small business owners, everyday small business owners, rural small business owners, from the capital necessary to borrow the money to create a more sustainable, more resilient, healthier community. When the failure happens, ultimately, the new level of supervision that says we're going to put more capital on the sidelines only impacts entrepreneurs, only impacts seniors hoping for a better return, only impacts everyday Americans living paycheck to paycheck, trying to figure out how to make this economy and this system work for them. I don't know how we explain to the small business owner who can't get a loan because we've improved the capital standards by having more cash on the sideline so there's fewer dollars to loan out. That, because you didn't do your jobs, sounds like doubling down and making the average person in the country pay a very high price for your failures. I think you're making it more and more difficult for the average American in the average place to contribute to a thriving economy.
Thank you, Senator Scott. I'll introduce today's witnesses. Federal Reserve Vice Chair for Supervision, Michael Barr, welcome. FDIC Chair Marty Gruenberg, welcome. And CUA Chair Todd Harper, welcome. All three of you been here many times. Acting Controller of the Currency, Michael Hsu, welcome back. New York Department of Financial Services Superintendent Adrienne Harris, welcome to the committee. California Department of Financial Protection and Innovation Commissioner Chloe Hewlett, welcome. Mr. Barr, please begin your testimony.
Chairman Brown, Ranking Member Scott, and other members of the committee, thank you for the opportunity to testify today. Overall, the U.S. banking system remains strong and resilient, and depositors should be confident that all deposits in our banking system are safe. At the same time, recent stress in the banking system shows the need to be vigilant as we assess and respond to risks. My review of Silicon Valley Bank's failure demonstrates that there are weaknesses in regulation and supervision that must be addressed, and I am committed to doing so. I am also committed to maintaining the strength and diversity of the banking system so that it can continue to provide financial services and access to credit for households and businesses. As we consider adjustments to our rules and supervisory practices, I am sensitive to how changes may affect banks in the current economic environment. My written testimony and accompanying supervision and regulation report provide detail on conditions in the banking sector and supervisory and regulatory efforts of the Federal Reserve over the last 6 months. Let me turn to the SVB review. Immediately following SVB's failure, I led a review of the Federal Reserve's supervision and regulation of the bank. Staff who were not involved in the supervision of SVB conducted the review. The resulting report takes an unflinching look at the conditions that led to the bank's failure, including the role of Federal Reserve supervision and regulation. There are 4 key takeaways from the report. First, SVB's board of directors and management failed to manage the bank's risks. Second, Federal Reserve supervisors did not fully appreciate the extent of the vulnerabilities as SVB grew in size and complexity. Third, when supervisors did identify vulnerabilities, they did not take sufficient steps to ensure that the bank fixed those problems quickly enough. Fourth, the board's tailoring approach impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. The 4 key takeaways show failures by SVB's board and senior management and failures by the Federal Reserve. I will outline how we can strengthen both our regulation and supervision based on what we have learned and based on the Federal Reserve's existing authorities. On the regulatory side, SVB's failure confirms the importance of strong levels of bank capital. While the proximate cause of SVB's failure was a liquidity run, the underlying issue was concern about its solvency. Stronger capital will guard against the risks that we may not fully appreciate today and will also reduce the costs of bank failures. In addition, we need to reconsider our prudential requirements. These include evaluating how we treat available for sale securities in our capital regulations, how we supervise and regulate a bank's management of interest rate risk, how we supervise and regulate liquidity risk, and how we oversee incentive compensation practices. Any adjustments to our rules would, of course, go through normal notice and comment rulemaking and have appropriate transition periods. I also plan to improve the speed, force, and agility of supervision. Supervision should intensify at the right pace as a bank grows in size or complexity. Once identified, issues should be addressed more quickly, both by the bank and by supervisors. Moreover, we need to ensure that we have a culture that empowers supervisors to act in the face of uncertainty. I want to reiterate that the banking system remains strong and resilient. Recent events demonstrate that we, as regulators, must do better, and we will. Thank you, and I look forward to your questions.
Thank you, Mr. Vice Chair. Chair Gruenberg.
Thank you, Mr. Chairman. Chairman Brown, Ranking Member Scott, and members of the committee, thank you for the opportunity to appear at today's hearing on oversight of financial regulators. The U.S. banking industry has proven to be quite resilient during this period of recent stress. Early reports from first quarter 2023 indicate that first quarter aggregate bank net income was roughly unchanged compared to the fourth quarter of last year, excluding the effects on acquirers' incomes of their acquisitions of failing banks. In addition, asset quality metrics remain favorable, and the industry remains well capitalized. Recent declines in medium and long-term interest rates have reduced somewhat the volume of unrealized losses on securities. Still, insured depository institutions will continue to face significant challenges in the near term. Risks to the outlook include the potential for weakening credit quality and profitability that could result in further tightening of loan underwriting, slower loan growth, and higher provision expenses. Commercial real estate loan portfolios, particularly loans backed by office properties, face challenges should demand for office space remain weak and property values continue to soften. The FDIC continues to monitor liquidity closely, including deposit trends across the industry, and will publicly release data on the first quarter of this year as part of its quarterly banking profile later this month. Last week, the FDIC Board of Directors approved a notice of proposed rulemaking providing for the special assessment required by law to recover the loss to the Deposit Insurance Fund attributable to covering the uninsured deposits of Silicon Valley Bank and Signature Bank. Under that proposed rule, the FDIC would apply an annual special assessment rate of about 12.5 basis points to an assessment base that would equal an insured depository institution's estimated uninsured deposits reported as of December 31, 2022. The assessment is defined in such a way that no banking organizations with total assets under $5 billion would be subject to the special assessment. On May 1st, the California Department of Financial Protection and Innovation appointed the FDIC as receiver for First Republic Bank. The FDIC was able to market and sell First Republic concurrently with its closure by entering into a purchase and assumption agreement with J.P. Morgan Chase Bank, following a competitive bidding process to assume all of the deposits and substantially all of the assets of First Republic. The FDIC estimates that the failure of First Republic will cost the Deposit Insurance Fund about $13 billion. The FDIC recently released 2 reports on the FDIC supervision of Signature Bank and options for deposit insurance reform. The report on Signature Bank, conducted by the FDIC's Chief Risk Officer, found that the root cause of Signature's failure was poor management, but also identified areas where the FDIC's supervisory efforts could have been more timely, forward-looking, and forceful, findings that will be matters of close attention by the FDIC. The report on options for deposit insurance reform identified increased targeted coverage for business payment accounts as capturing many of the financial stability benefits of expanded coverage while mitigating moral hazard effects. Finally, the failures of Silicon Valley Bank and Signature Bank demonstrate the implications that banks with assets of $100 billion or more can have for financial stability. The prudential regulation and supervision of these institutions merit additional attention, particularly with respect to capital, liquidity, and interest rate risk. My prepared testimony goes into all of these matters in considerable detail. The FDIC remains committed to engaging with the public, industry stakeholders, and members of Congress on the policies and priorities outlined in my testimony. That concludes my statement, and I'd be glad to respond to questions.
Thank you. Chair Harper.
Chairman Brown, Ranking Member Scott, members of the committee, thank you for the invitation. My testimony outlines the state of the credit union industry, some of the NCUA's recent efforts to strengthen the system, and several legislative requests. So I will focus here on only a few key issues. Overall, the performance of federally insured credit unions remains stable. Total loans, assets, insured shares, and deposits all increased last year. What's more, the system's aggregate net worth ratio rose to 10.75%. Significantly, 9 out of every $10 in share deposits within federally insured credit unions are insured. That has contributed to stability within the credit union sector in recent months. The NCUA's Share Insurance Fund also continues to perform well. Although the fund's equity ratio is 3 basis points below the desired operating level, no premiums are expected at this time. That's because the system is currently well positioned to handle any dislocation resulting from a moderate recession. Nevertheless, during the last year, we have experienced growing interest rate and liquidity risks within the system, including at several billion-dollar-plus institutions. Aggregate cash positions have declined and are below pre-pandemic levels as well. Further, unrealized losses in securities limit their utility as a source of liquidity. The recent increase in these risks underscores the value of the NCUA's Central Liquidity Facility. Otherwise known as the CLF, the facility acts as a shock absorber to contain or avert liquidity crises before they escalate. However, with the termination of the temporary CLF statutory enhancements last December, more than 3,000 credit unions, each with less than $250 million in assets, lost access to the CLF, contracting the facility's capacity by almost $10 billion. With risks rising in the financial system and at individual credit unions, now is not the time to cut a liquidity lifeline. As such, the NCUA board fully supports restoring the ability of corporate credit unions to serve as CLF agents on behalf of a subset of their members. Notably, the Congressional Budget Office has scored these reforms at no cost to the taxpayer. Additionally, with increased industry concentration, intensifying cyber threats, and greater outsourcing of core business functions, the Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Inspector General have all recommended congressional action to restore the NCUA's statutory examination authority over third-party vendors. I fully agree and respectfully request that Congress close this growing regulatory blind spot. Lastly, the NCUA defers to Congress on determining what statutory changes, if any, should be made to deposit insurance coverage levels and account types. But if Congress does act in this area, the NCUA has 2 requests. First, we ask Congress to maintain parity between the share insurance coverage provided by the NCUA and the deposit insurance coverage provided by the FDIC. And second, because an expansion of coverage will generally increase resolution costs, the NCUA requests greater flexibility for administering the share insurance fund. This flexibility, which would be more in line with the FDIC's current administrative powers, includes allowing the NCUA board to establish a higher normal operating level and modifying the current limitations on assessing premiums. Together, these changes would better enable the NCUA board to build reserves during economic upturns so that sufficient money is available during economic downturns. In sum, the credit union system currently remains well capitalized, stable, and well-positioned to handle a relatively broad range of economic outcomes. and the NCUA stands ready to respond to any economic uncertainty and will continue to work through the supervisory process with any individual credit union experiencing problems. In doing so, we will be forward-looking, risk-focused, and ready to act expeditiously. Consumers, therefore, should remain confident that their insured share deposits at federally insured credit unions are safe. And the NCUA stands ready to work with Congress on any legislative reforms to strengthen and safeguard the system. Thank you again. I look forward to your questions.
Thank you, Chair Harper. Controller Hsu.
Thank you, Mr. Chairman. Chairman Brown, Ranking Member Scott, members of the committee. I'm pleased to appear today to offer my observations about the recent market stress and to answer any questions you may have regarding the activities and priorities of the OCC. Since March, I have worked especially closely with my peers at the other banking agencies to maintain financial stability and confidence in the financial system. Adequate levels of capital going into the recent turmoil have helped to limit the risk of contagion. Despite the market stress, the federal banking system has remained resilient, and national banks and federal savings associations have remained well-positioned to serve their customers. None of the 4 large banks that failed were regulated by the OCC. Notwithstanding, we are closely monitoring the conditions of the institutions we supervise and working with them to ensure that their liquidity and capital positions remain sound and that they are on the balls of their feet with regards to risk management. Many have taken steps to reduce risk in light of market conditions, and to date, the vast majority of OCC-supervised banks have not experienced stress with regards to their depositors or business customers. Over the past 2 years, I have consistently emphasized to bankers the importance of guarding against complacency and having strong risk management policies and practices in place. Most OCC-supervised banks have heeded this message and successfully navigated the rise in interest rates and changing economic outlook. OCC examiners will continue to actively monitor market conditions and engage with banks to help ensure that they are prepared to meet future challenges. Based on my perspective as acting comptroller and 20 years of experience as a financial regulator, I want to share some observations on steps that can be taken to restore full confidence in the banking system. First, supervisors need support to act in a timely and effective manner. Supervisors at the OCC and the other banking agencies play a critical role in keeping the banking system safe and sound by exercising discretion. The degree to which supervisors feel empowered to exercise that discretion impacts their will to act in a timely and forceful manner. Clear support to empower supervisors to exercise discretion and act when needed will help keep the banking system safe and sound. Second, regulations regarding the resilience and resolvability of large banks need to be strengthened. Stronger resiliency requirements for large banks with regard to capital and liquidity would have reduced the probability of recent bank failures. Stronger resolvability requirements would have facilitated orderly failures with less government involvement. The OCC is working closely with the Federal Reserve and FDIC to address these issues. Third, deposit insurance coverage should be updated. The FDIC's recent report on deposit insurance is worth careful consideration, especially its conclusion regarding targeted expansion. In the meantime, we've been working with our banks, especially those with significant levels of uninsured deposits, to ensure that their cash holdings and borrowing capacity can meet depositor withdrawals. We remain committed to supervising banks so that depositors can rest assured that their money is safe. Finally, the diversity of the banking system must be preserved as the industry evolves. The OCC has been working on updating the analytical frameworks related to the bank merger guidelines that the federal banking agencies and DOJ must follow when considering bank mergers. The recent turmoil has increased the urgency of these efforts. The OCC is committed to being open-minded when considering merger proposals and to acting in a timely manner on applications consistent with the requirements of the Bank Merger Act. As the industry evolves, I believe strongly that we must preserve the diversity of the banking system, from community banks to mid-sized banks to regional banks. Going forward, continued industry and regulatory vigilance is critical. Banks and supervisors must be attentive to the most salient risks today, as well as those beyond the daily headlines. That will help ensure that the banking system remains a source of strength to the U.S. economy. Before closing, Mr. Chairman, I want to be very clear. Our customer is the American people, not banks, period, full stop. Thank you. I would be happy to answer any questions.
Superintendent Harris, welcome to the committee.
Thank you so much. Good morning, Chairman Brown, Ranking Member Scott, and members of the committee. On Sunday, March 12th, 2023, Signature failed after experiencing a propulsive run on deposits on Friday, March 10th. The run was instigated by the self-liquidation of Silvergate Bank on March 8th, and then the failure of Silicon Valley Bank on March 10th, following an unprecedented run on its own deposits. In order to avoid a disorderly midday Monday shutdown and further contagion across the banking system, on the evening of Sunday, March 12th, DFS took possession of Signature and appointed the FDIC as receiver. Before its failure on March 12th, regulators had documented liquidity-related regulatory concerns to the bank, beginning with the 2018 report of examination. Despite orders from regulators, the bank was slow to remediate supervisory recommendations, and many issues identified by the regulators remained unresolved when the bank failed. Signature's inability to remediate the outstanding liquidity management issues undoubtedly contributed to its collapse. However, the immediate cause of the bank's failure was an unprecedented run on deposits instigated by the self-liquidation of Silvergate and the subsequent failure of SVB. On Friday, March 10th, Signature experienced a runoff of $18.6 billion in deposits in a matter of hours, reducing the bank's deposit base by 20%. Throughout the day, Friday and into the night, the regulators worked closely with each other and Signature to find sufficient liquidity to satisfy the significant volume of customer withdrawal requests. After avoiding a default on Friday, regulators had time over the weekend to assess Signature's condition and come to a considered view as to whether the bank could open safely on Monday. DFS had one objective that weekend: to preserve the safety and soundness of the financial system. 3 paths were identified for the bank in order of preference. The first was to find a way for Signature to open in a safe and sound manner on Monday and continue as a stable institution. The second was to find a purchaser for the bank on an open bank basis. Third, DFS and the FDIC worked in parallel to prepare for the last resort scenario of taking possession of the bank and appointing FDIC as receiver. The regulator spent the weekend collecting and evaluating information from Signature in order to make a data-driven decision about the bank's viability. Signature's inability to provide reliable data and a credible liquidity strategy to operate in a safe and sound manner on Monday led DFS to take possession of the bank and immediately appoint the FDIC as receiver. At the time DFS took possession, the bank had $4.27 billion of certain liquidity available for Monday morning to cover known withdrawals ranging between $7.4 and $7.9 billion. These withdrawal estimates do not include additional unknown withdrawals that could reasonably be anticipated on Monday in light of market conditions. Taking possession of the bank was the option of last resort to avoid a disorderly Monday shutdown and stop any further panic and contagion across the broader banking system. DFS-regulated financial institutions are safe and sound today, but the department has instituted heightened monitoring of banks with higher risk profiles and is implementing recommendations made by our Office of General Counsel to modernize the supervision of the global financial system. Thank you, and I look forward to your questions.
Thank you, Superintendent. Commissioner Hewlett, welcome.
Chairman Brown, Ranking Member Scott, and members of the committee, I appreciate the opportunity to testify on behalf of the California Department of Financial Protection and Innovation. My name is Clothilde Hewlett. I've served as commissioner since December of 2021. Building on over 100 years of state regulation, the current department was restructured in 2020 to strengthen California's financial oversight. DFPI has broad authority touching every aspect of the financial sector in California, including banks and credit unions. Through regulations, supervision, and enforcement, DFPI promotes safety and soundness and consumer protection. State-chartered banks like Silicon Valley Bank are regulated by both state and federal regulators. State regulators play a vital role in maintaining the strength of the dual banking system, particularly for local banks that serve diverse communities throughout the community. State regulators supervise almost 80% of all banks in the U.S., which equates to more than 3,800 banks and $8.5 trillion in assets. This includes overseeing 2/3 of agricultural lending and half of small business lending. The localized supervision equips state regulators to better understand the unique demands faced by banks in local communities. In California, DFPI supervises 99 state-chartered banks with an average asset size of approximately $4 billion, nearly under $1 billion in assets, and 9 of our banks are over $10 billion. The department also supervises 113 credit unions with an average asset size of $1.4 billion. For nearly 40 years, Silicon Valley Bank was an important service provider to California's tech economy, the life sciences and healthcare sector, nonprofits, and small businesses. On March 8th, the bank announced a loss of $1.8 billion and a capital raise. Depositors reacted by initiating withdrawals of $42 billion, or approximately 25% of total deposits, over a 24-hour period, causing an unprecedented run on the bank. At the end of March 9th, the bank had a negative cash balance of approximately $958 million. We determined the bank was insolvent. On March 10th, DFPI took possession of the bank and appointed FDIC as receiver. The DFPI examined the bank in coordination with its primary federal regulator, the San Francisco Federal Reserve Bank. Federal examiners led the examination of Silicon Valley Bank's compliance with federal regulations related to enhanced prudential standards and review of SVB's liquidity and interest rate risk. The department and SFED flagged concerns about the bank's liquidity management beginning in 2021 and interest rate risks beginning in 2022. Though it is typical to provide time to remediate, the timelines were not acceptable. The department has conducted and published an internal review of the supervision and the closure of Silicon Valley Bank. That review and the recent failure of First Republic Bank highlight the need to make changes to promote safety and soundness of state-chartered banks. The DFPI is committed to working with federal legislators to develop stronger and more effective systems to promote and promptly remediate deficiencies and better allocate staff according to risk. The DFPI will increase its focus on a bank's level of uninsured deposits and require banks to evaluate and account for emerging risks posed by technology-enabled activities such as social media and real-time withdrawals. I look forward to working with Congress, our federal regulatory partners, our California state legislature to implement changes that strengthen our financial system. Thank you very much.
Thank you, Commissioner. As outlined in the failed bank reviews you conducted, regulators identified risks like interest rate risk, liquidity risk, and corporate governance issues. As any good banker knows, when regulators point out problems, you fix them right away. Once issues were identified by the regulators, the CEOs of SVB and Signature suggested at our hearing on Tuesday that their leaders corrected deficiencies in a timely way. Mr. Barr, Mr. Gruenberg, Ms. Hewlett, Ms. Harris, answer yes or no if you would. Is that true? Did they quickly fix the problems your examiners identified?
They fixed some problems, but most of them not. There were 31 outstanding matters requiring attention or immediate attention at the time that they failed.
Mr. Gruenberg?
No, Senator.
Ms. Harris?
No, Senator.
Ms. Hewlett?
No.
Thank you. This goes to all 6 of you. Will you commit to improving both examinations and enforcement to crack down harder and faster on bank executives that just don't listen? Mr. Barr?
Yes.
Yes, Mr. Chairman.
Yes.
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 Thank you. In response to Senator Round's question on Tuesday about removing hedges from SVB's investment portfolio, Greg Becker, the CEO of SVB, as we know, threw up his hands and, pardon my cliche, but this one actually fits, pushed his employees under the bus. Of course, the CEO of a bank is ultimately responsible for crashing his bank. Chair Gruenberg, is it difficult to hold senior executives of large, complex institutions accountable and ban them from driving another bank into the ground?
Oh, Senator, we certainly have the authority to do that and have done that in the past and have to be prepared to do that going forward.
Controller Hsu, do you agree?
I agree.
Okay. We need to close these gaps, and I know many members of this committee on both sides of the aisle agree. I listened to pretty much all of them with Mr. Becker and with the 2 executives from Signature. I'm working on legislation to make sure executives of big banks like Silicon Valley can't hide behind their subordinates to avoid accountability. Let me follow up on the impact of fast growth, a subject that most of you have touched on and was the subject of much of the testimony on Tuesday. Your reports explain that the problems of SVB and Signature got worse because the rules for larger, more complex banks do not apply immediately as banks grow larger. A prominent bank lawyer recently testified in a House hearing that these rules need to be revisited because essentially long transition periods allow a $200 billion bank like SVB to be treated like a $50 billion bank. This question is for Vice Chair Barr and Commissioner Hewlett. How did the transition period that SVB had before the large bank rules kicked in contribute to its condition and ultimate failures?
Well, under the prior approach, they would have had heightened prudential standards applying to them as they grew in size over the last 3 years. Because of the way the tailoring rule worked at the Federal Reserve, they basically had
That was Mr. Quarles. That was Vice Chair Quarles' tailoring rule, correct?
But the board as a whole made the decision to put that rule in place in 2019,
But he had your job at that time, correct?
he did. He was vice chair for
And
Supervision.
he led on that effort, and typical culture at the Federal Reserve is if someone's empowered to do certain things, whether it was Lael Brainerd on CRA or Mr. Quarles in that job, the Fed generally follows, correct?
The vice chair for Supervision has explicit statutory authority to take the lead in supervision and regulation.
Okay. Ms. Commissioner Hewlett, your comments on that?
Yes, there was a new program, regulations put in place by our federal partners, the Large Foreign Bank Organization Program. Silicon Valley Bank was the first bank, due to its rapid growth, to move from being a regional bank into that program. And the transition, because it was the first, took a much longer time than what it normally would have taken if the program had been in place. And that transition is a lot of what contributed to the delay.
Thank you. It sounds like the so-called tailoring rules advocated by the former vice chair for supervision were set up to fail. And as I think all of you remember, neutral observers who don't see the banks as customers or clients in the regulatory process warned about Mr. Quarles weakening those rules. And I think we will see a lot about fixing that in the future. This is for Mr. Gruenberg and Ms. Harper. Mr. Harper, I'm sorry. Earlier this week, the failed bank executives gave a lot of excuses, but failed to take responsibility for their mismanagement and their incompetence. The community banks and credit unions I talked to know that dangers were not hard to spot, like a high concentration of uninsured deposits and aggressive growth. As we know, 90% of top deposits at SVB were uninsured, unlike any other bank that I know of comparably sized, certainly in my state. Neither SVB nor Signature look like an ordinary bank, in part because of that. Chair Gruenberg, and I'm running out of time, so, and Chair Harper, if you would, we've seen the risk develop from an over-concentrated uninsured deposit base. What tools do the regulators have to make sure banks manage those risks?
We certainly have supervisory authorities to review and set limits on concentrations. I think that's one of the key areas we need to look at going forward, concentrations of uninsured deposits at institutions. It clearly poses a liquidity risk that we need to focus on going forward, Senator.
Thank you, Chair Harper.
We also have concentration limits as well as our liquidity rules that are in place, although if I could reemphasize here the importance of acting on the central liquidity facility reforms so that we can make sure that small credit unions across the board have access to the facility. That would be an important reform for Congress to make.
Thank you, Senator Scott.
Thank you, Mr. Chairman. I find it interesting that today is May 18th, 2023, time is 10:22, and I've not wondered recently, but listening to this hearing, I think the American people may be asking themselves, what is the definition of scapegoat? If we were looking for a definition of scapegoat, please watch this hearing, because literally what we're hearing today is scapegoating. I keep hearing about the predecessor, who left in December 21. Mr. Barr, you started in July 2022. According to Ms. Hewlett, the liquidity and interest rate risk manifested itself in 2021, which means it was already there. Coming into a new job, you have an opportunity to take responsibility for a very important role in maintaining strength and health in our financial system. Yet we continue to hear about the predecessor. One of the most important values of being an American is taking responsibility. It's that simple. When I was a kid, not doing well in high school, I wanted to blame somebody else for my failures. Wanted to blame my mom because she was working long hours, my dad because he was not around. You know, I had a mentor who taught me, actually, look in the mirror, blame yourself. Because if you want to find the solution, you've got to find the problem. And today we're dancing around the obvious problem that we're not looking in the mirror and blaming yourselves. There are things that could have been done to eliminate the risk. But instead of that, we are playing a game of scapegoating. And I don't think that the American people buy it. And if we all wanted to know why the ratings of politicians in this country are so darn low, watch this banking hearing. It's pretty clear. I'm struck by the fact that the Fed was able to issue 31 supervisory findings with the tools they already have. And yet somehow, they need more. Your cover letter, Mr. Barr, says that the Silicon Valley Bank's failure highlights the importance of stress testing and other supervisory tools. Yet one of your first actions as vice chair was to pilot a climate scenario analysis exercise. Additionally, in your first speech as vice chair, you highlighted a number of priorities, which included financial risks from climate change, but crucially, did not note any of the risks that actually led to the failure of SVB. In fact, the day we learned about the failings at SVB, March 9th, you were giving a speech. The banks we regulate, in contrast, I assume to crypto, are well protected from bank runs through a robust array of supervisory requirements. In other words, we have the tools we need to do the job assigned to us. But today, we're hearing scapegoating. It's frustrating when I think about all the people, 330 million of them, who depend on us just to do our jobs. And when we don't do our jobs, to take responsibility for not doing them. Today, that's not the conversation we're having. But the result of us not doing our jobs and then asking for more power, more control over the economy is, according to the survey, lending standards are tightening, and that further restricts access to credit. And the way we translate that at home in North Charleston, South Carolina, is access to the American dream. It starts to wilt away. Because if the American dream is synonymous with home ownership, if the American dream is synonymous with starting a business, there seems to be a leak. And we can detect where the leak is coming from. Are you concerned about the ripple effect of the potential new regulations on those at the lowest end of the credit quality spectrum, given the tightening that we're seeing in the marketplace? And more regulation means less capital, which means fewer loans, which means fewer people achieving the dream. Mr. Barr.
Thank you, Senator Scott. First of all, let me be absolutely clear. I accept full responsibility with respect to the supervisory failings at the Federal Reserve. I have been clear about that from the start, and I remain clear about that today.
Thank you, Mr. Barr.
The buck stops here.
Thank you.
And I am committed to fixing the problems that we've had in supervision and regulation going forward.
Thank you, sir. Who did you fire?
We have not fired someone as a result of this review.
Thank you.
We plan to conduct further review of our supervisory structure, and as we do that, we'll be making sure we have the right personnel in place to get the job done.
I hope that includes making room for the right personnel by removing the wrong personnel. Thank you.
Senator Reed of Rhode Island is recognized.
Well, thank you very much, Mr. Chairman, and thank you, panel, for your excellent testimony. I want to just take a moment to look back at, we had a hearing last week on the Safe Bank Act, and it's designed to provide access to banking for the cannabis industry. I'll be technical. But in that provision, Section 10 of the Safe Banking Act, there is language that would prohibit supervisors from requesting that a bank cut ties with customers in any industry, even if those customers present a high risk, unless there's only one exception. The bank has broken the law by maintaining the relationship. Mr. Barr, will this adversely affect regulation?
Well, thank you, Senator Reed. I think it's important that Congress is taking on this issue of the potential conflict between state and federal law. Let me say, with respect to Section 10, on the one hand, I don't think it's the federal supervisor's job to tell a bank who to lend to or who not to lend to. On the other hand, I would be concerned about any language that would limit the ability of a supervisor to take prompt action, to take aggressive action, to ask hard questions. I think one of the things we've seen with respect to the institutions we're talking about today is we need supervisors to do that, not to hold back. And so we'd be happy to work with the committee on any reforms that are needed with respect to that provision.
Thank you. Mr. Hsu, your position as acting comptroller.
I agree with Vice Chair Barr. It's vitally important that supervisors have discretion to identify risks and to act on those in a timely manner, and that includes requiring remediation. And so I'm not comfortable with any limitations on supervisors' ability to enforce compliance with rules such as the BSA, AML Act, and CFTC rules.
Thank you very much. Mr. Barr, capital stress tests were put in effect by Dodd-Frank. The Federal Reserve organizes, creates the test. It proposes the test upon the banking institution. The results are made public so that everyone could know. That is not the case with liquidity testing. Is that correct?
Yes, the framework for liquidity stress testing and for interest rate stress testing are internal to the supervisory process. They're not a public exercise.
And in fact, when several times SVB was noted by the Federal Reserve privately of failing its liquidity test. Is that correct?
Yes, that's correct, sir.
And no action was taken?
Action was taken, but some of it was quite counterproductive with respect to the actions taken. So, for example, one step that the bank took with respect to liquidity risk is when it saw that it was breaching its liquidity limits, it changed the modeling assumptions to make the test less conservative.
So, yeah, so it took the test, it failed the test, then it rewrote the test and passed the test, which is, good if you can do it. I presume and hope that the Federal Reserve is looking closely at adopting stronger liquidity rules, i.e. very similar to the capital rules. And
Yes, Senator.
let me ask one other question. The president of SVB, Mr. Baker, was also on the board of the San Francisco Fed.
Yes, that's correct.
Did that in any way influence the treatment of this bank?
The evidentiary record that the review looked at did not find evidence of that. Of course, the structural issues are there.
Oh, no, absolutely. It's, again, you've got a bank that's changing the test because they failed, and then you've got a bank being inspected by someone who is, in a way, directly accountable to the president of that bank.
The board structure, the way it works under the Federal Reserve Act, a third of those members are selected by the local bankers and our bankers. They're forbidden from having anything to do with supervision as a matter of policy and law. And so that's the structural way that the Reserve Act intends to deal with those issues.
Yes, but rather than structural or institutional in the human dimension, if someone's sitting on your board, and even though they have no legal rights, there is a certain sensitivity, I would expect, by the inspectors.
Again, the evidentiary record we have from the review does not show that in this case.
Well, I think that's another area where you might look at. Thank you very much, Mr. Chairman.
Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and thank you all for attending today and participating. Vice Chairman Barr, the Federal Reserve issued an MRA, matter requiring attention, for SVB's interest rate risk. This was in November of 2022. The supervisory findings stated that the firm's interest rate risk simulations were unreliable and that they gave a false sense of safety in the rising rate environment and really masked the need to take actions earlier in the rate cycle. Greg Becker, who testified before us, the former SVB CEO, told this committee on Tuesday that findings in writing are done in some cases months after the initial verbal feedback is given. Vice Chair Barr, when did the Fed give the initial feedback regarding interest rate risk to SVB, and why was simply an MRA issued as opposed to an MRIA?
I believe in that case, the writing was actually quite close in time to the finding of difficulty with the interest rate risk modeling. As you suggested, the basic problem was that the model was showing that the firm would be earning more money when interest rates rose, and the opposite was actually the case. In terms of the timing for remediation, I think that one of the findings of the review is that the Federal Reserve staff could have pushed harder on the firm to move faster with respect to remediation. Of course, the time frame between November and March was pretty tight, and the firm failed in March.
Was that perhaps because SVB actually had about 15% in the ratio for their Tier 1 capital on hand at that time, which is a pretty high amount of capital?
They did have a high amount of capital. It didn't really help with respect to their particular interest rate risk and liquidity risk.
It was a liquidity issue, not a capital issue.
The solvency of the firm, as I said in my testimony, was what drove the liquidity risk. That is, depositors looked at the balance sheet of the bank, and despite its regulatory capital being high, they viewed it as insolvent. And one of the reasons for the view of that is that under the capital rules that were applied to SVB, SVB did not have to pass through its unrealized losses into its capital treatment. And so its capital treatment was really a little bit higher than it ought to have been if it had passed through those unrealized losses.
And if we would have been talking and focusing on the liquidity issue in particular, because basically under the rules that they were following, the liquidity became the issue at the time. At one point, their capital was up but they were not recognizing the losses that would have occurred if they had to convert those bonds that they were carrying.
Correct.
Yeah, okay. Also, on Tuesday, when he was in here, the former SVB CEO claimed that as of early 2023, all but one supervisory finding was remediated. Is this true? And if so, was this interest rate risk one of those that was remediated?
That is not true, Senator Rounds. At the time the institution failed, they had 31 outstanding matters requiring attention or immediate attention, including those that are related to interest rate risk and liquidity risk, as well as broad issues of risk management at the bank. It was rated deficient 1, not well managed at the time it failed.
They still had 31 supervisory findings when it failed.
Correct.
Mr. Gruenberg, I'm just curious. You have a clawback authority right now, and if I understand it correctly, for the most part, it has to show that there was wrongdoing or basically criminal activity involved in the clawback for executives, with one exception, and that is if the secretary, as I read it, if there is a written recommendation by the Federal Reserve and the FDIC, the Treasury Secretary, in consultation with the President, shall appoint the FDIC receiver of a covered financial company if, among other determinations, the financial company is in danger of default. The failure would have serious adverse effects on financial stability, and there is no viable private sector alternative to failure. And this was apparently met. And therefore, after such an appointment, the FDIC may recover losses from the compensation of any current or former senior executive or director who is substantially responsible for the failed condition of the institution. Recoupment is limited to a 2-year period preceding the date on which the FDIC was appointed as receiver, and the FDIC must weigh the financial and deterrent benefits of recovery against the cost of execution. Mr. Gruenberg, are you recouping or clawing back the bonuses that those executive officers received in the SVB bank failure?
Thank you for the question, Senator. Under the Federal Deposit Insurance Act, we have authority in the case of a failed institution to investigate the executives and the board of the institution for any wrongdoing, and we have authority to order restitution if there was improper conduct. We also have authority to ban individuals from the business of banking.
Did you invoke this and use the clawback provisions?
I mean, we are pursuing investigations. We obviously have to determine what conduct occurred, to determine if there was misconduct that would give us the authority to,
With the chairman's indulgence, I'd just like to finish this line of questioning if I could.
Yeah.
Sure.
Look, you've got executive officers in a bank who not only received bonuses for showing a better rate of return because, in part, they eliminated the hedging which was protecting those deposits. And at the same time, there was a change apparently within their guidelines during this period of time in which they actually received a higher rate of return based upon the amount of income or return. So by eliminating the expense of protecting the assets of these depositors, they bumped their bonuses. And I guess my question is real simple. Are you in the middle of an investigation, and do you plan on pursuing, if no other reason, deterrent to others who might think this is a cool way to make a lot of money, like millions of dollars? Or are we going to just simply wait back and this thing just kind of floats away?
The answer to your question, Senator, is yes.
Thank you, Senator Rounds.
Thank
Senator Menendez from New Jersey is recognized.
Mr. Barr, your report identified major weaknesses in Silicon Valley Bank's incentive compensation program, noted that it, quote, encouraged excessive risk-taking to maximize short-term financial metrics, close quote. It goes on to say that SVB's compensation practices, quote, did not adequately reflect longer-term performance, non-financial risks, or unaddressed audit or supervisory issues. So, Mr. Gruenberg, Mr. Harper, Mr. Hsu, with a simple yes or no, do you agree with Mr. Barr's analysis?
Yes.
Yes.
Yes, Senator.
Okay. As I noted in our hearing with the executives on Tuesday, the incentive structure SVB put in place rewarded breakneck growth and profitability, while kneecapping efforts to manage growing risks to the firm. Mr. Barr, in questions for the record following your confirmation hearing, I asked if you would work with the other financial regulator to develop and swiftly implement a strong incentive-based compensation rule, a rule that is required under Dodd-Frank that is more than 10 years overdue, so that we can prevent the type of situation we saw at SVB. So, Mr. Barr, if the 2016 proposed rule on Section 956 had been implemented, would that have mitigated some of the problems with SVB's incentive compensation that you noted in your report?
Yes, I think it would have assisted in that effort.
Mr. Barr, Mr. Gruenberg, Mr. Hsu, and Mr. Harper, can each of your agencies have a role to play in finalizing this rule? Will you commit to acting on this rule quickly, since it's already 10 years overdue?
Yes.
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 Yes, Senator.
Well, I appreciate that, because I have a sense, having sat here through the great recession, almost the financial collapse, listening to all we were asked to do as members of the banking committee back then, that when we pass things, we seem to get a veto by omission, which means maybe the regulators don't like what we say, but it's the law. And then nothing happens. A decade. At some point, gentlemen, you have responsibility. So I hope we will get to that quickly. Vice Chair Barr, your report on the supervision of SVB reveals that federal examiners gave the bank's management satisfactory ratings, quote, even after supervisors began identifying and communicating issues with governance and risk management in 2018. The Fed continued to award management satisfactory ratings despite identifying significant concerns year after year. Why are supervisors apparently so reluctant to downgrade the bank's ratings? What changes, if any, do you plan to make to ensure banks are rated accurately when significant risks are identified?
Thank you, Senator. I do think the report identified that the supervisors were very slow to change ratings when they found problems. Part of that had to do with the standards that were set. Part of that had to do with the fact that it is, as a supervisor, hard to push back on a bank when they're earning a lot of profit and growing rapidly and the economy is doing well. So we need to have a way to make sure that our supervisors feel empowered to take action promptly. We need to give them the tools to do that, and we need to change the supervisory culture. One of the first things I did when taking this job was to go talk to supervisors around the system, telling them I wanted to make sure that they were asking the hard questions, being tough, that they were standing true, and that they were agile, looking for new risks in the system. I think we have to keep at that and change the culture.
Well, another item from the report that concerns me is that supervisors, quote, saw financial performance and the lack of realized risk outcomes during this period as offsets to underlying concerns related to governance and risk management. Now, to me, this shows that the Fed examiners fundamentally misunderstood their role in enforcing a safe and sound banking system. Your job is to identify risk proactively and ensure that they are fixed before they impact performance. Since we've seen time and time again that the banks themselves do a poor job of it. Can you commit to us, Mr. Barr, that you will sharpen the focus of your supervisory efforts on proactively identifying and ensuring banks fix vulnerabilities? I mean, from my mind, the purpose of regulators is to act as the cop on the beat, not to give everybody a pass.
Yes, I fully commit to that. I think we need to make our supervisory system much more agile, much faster, and much more forceful, and we will be doing that.
And I hope the other regulators do so as well. Thank you, Mr. Chairman.
Thank you. Senator Vance of Ohio is recognized.
Great. Thank you, Mr. Chairman, and thanks to the panel for tolerating this Arctic condition they've put this hearing room in. It's really cold in here. But I want to ask, direct my question to Mr. Barr. And one of my concerns here is that we have a San Francisco Fed that clearly was asleep at the wheel. I think a basic examiner's review would have said that Silicon Valley Bank had some serious problems, And the fact that we didn't identify it until the bank effectively blew up is a serious problem. So with those, one of the things we've seen is the San Francisco Fed is clearly focused on diversity, equity, and inclusion initiatives and also climate risk. And I, as a person who recognizes that if you're focused on one thing, you're fundamentally not as focused on other things, I want to sort of target this particular thing. So instead of focusing on the safety and soundness of our banking system, the San Francisco Fed was busy publishing economic letters and research on a number of social justice causes. Some of the selected titles include disappointing facts about the black-white wage gap, how are racial and gender gaps limiting the full potential of your state's economy, hosting seminars and publishing primers on racial equity, making a commitment that their equity goals would help to drive their approach to hiring, and that's not to mention their involvement in the Fed's Racism in the Economy series. Now, that's just after a quick scan of the San Francisco Fed's website. I worry that when you have the San Francisco Fed sounding a little bit more like an Ivy League political science or economics department, that you miss some things. And Mr. Barr, could you explain how this research and these activities support the Fed's monetary dual mandate or supervisory charge to ensure safety and soundness in the banking sector? How does this actually help?
Senator, let me start by just talking about the particular case of SVB. The review did not find any evidence that the supervisors were distracted by other activities. They were focused on the right set of risks in the bank with respect to liquidity, risk management, and interest rate risk. But the findings were that they didn't act forcefully enough to get the bank to move quickly enough to change those factors. So that's the basic backdrop. With respect to your question, the Federal Reserve banks do have a wide range of freedom being able to conduct research that they think is important to understanding economic drivers in our economy, and some of those economic drivers include the issues that you discussed.
So here I guess is the question is it your view, Mr. Barr, that if the Fed is doing these seminars on climate risk, on diversity, equity, inclusion, and so forth, instead of seminars on risk management, because again, there's only so much time in the day, do you just think that it doesn't have any effect on their focus and on the things that they're thinking about when they're doing their basic job?
The evidence in the review is that the supervisors were focused on the right set of risks. They were focused on basic, risk management at the firm in terms of interest rate risk, liquidity risk. They found that the bank was not well managed with respect to its activities. They were graded a deficient 1. So the issue, at least with respect to SVB, that we saw was that it was about the forcefulness of action that the supervisors didn't take in time to change the nature of the firm.
I appreciate that, Mr. Barr, and I understand that the review didn't find that this was distracting enough, but I just wonder, separate what the review found and think about the way that human minds work, where if we're focused on one thing, we're fundamentally not focused on something else. There's only so much cognitive bandwidth the average human being has. I really worry that the more that the regulators are focused on things that have nothing to do with systemic or individual financial risk, the less and less safe our financial system is going to be. And I understand that the point that you're making, the review found that the focus was not a problem here, but this is all overdetermined. It's incredibly difficult to say with any conclusive evidence, either in my direction or in your direction, that the focus on these non-risky financial issues caused a problem. But are you worried that we reach a sort of tipping point where the focus on building progressive politics into our risk assessment starts to actually harm our ability to really analyze whether these banks are a problem?
I don't think politics should play any role in risk assessment. And as I said, in this case, we don't see evidence of that in the record.
Well, I agree with that point. The politics shouldn't play any role here. And Mr. Chairman, I'll yield my time, but just to say that, I'll say this the third time actually. We can only do so much in a given day, and the more that we distract ourselves from focusing on financial risk and instead focus on climate risk and other things, I worry it's going to cause our financial system to be much less safe. Thank you, Mr. Barr.
Senator Tester of Montana is recognized.
Thank you, Chairman Brown and Ranking Member Scott, for having this hearing. And I want to thank all of you for your testimony, and thank you for being here. My guess is last night, probably the only two people that slept well were Harper and Hsu. But thank you all for being here. This morning, the good senator from North Carolina, Senator Tillis, and I are calling for an independent, comprehensive investigation into the recent bank failures. The stress these recent failures put on our financial system is having negative effects on community financial institutions, small business, hardworking families. And I believe we must get to the bottom of the recent failures to ensure our financial system isn't left on the hook for risky behavior by reckless executives and lackluster agency oversight. This is a question for all of you. You can nod or raise your hand. Would all of you support an independent review?
Yes, Senator.
We've been clear that we welcome additional reviews of all kinds.
All right, good. Let the record reflect. It's unanimous. Mr. Barr, I want to read you some your testimony, and then I want to ask you what this means. It's on the third page in my copy anyway. Finally, the fourth key takeaway is the Federal Reserve Board tailoring approach in response to the Economic Growth, Regulatory Relief, and Consumer Protection Act, and a shift in stance of supervisory policy impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. Absent these changes, SVB would have been subject to supervision within the LFBO portfolio and subject to heightened standards beginning in 2019 throughout the bank's period of rapid growth. Is it fair to say that every bank would have been subject to those same standards, not just SVB, but everybody?
Sir, I was referring to the approach based on the size of the asset class of institution. So other banks that were of a higher asset size would also have been subject to that rule, but not every bank.
No, but everybody in that asset size. So let me ask you this. Fundamentally, do you believe that the regulation should fit the risk?
Yes, I do, sir.
Okay. So if you looked at 2155, which is the other name for the longer title I just read, isn't it pretty clear the tailoring is allowed, even to the smallest community bank? If they had a risky portfolio, you could drop the hammer on them, as the chairman said, correct?
We have ample discretion under S2155 to take a risk-based approach to supervision.
Thank you for that. So the question becomes, Vice Chair Barr, are you going to propose new regulations in response to these failures?
I expect both in response to these failures and our broader review to look at changes in both supervision and regulation going forward.
So, but isn't your report relatively clear that it is not a regulatory failure? That if the tailoring would have been applied correctly, as 2155 talks about, as I believe Congress intended, that this problem could have been stopped?
The report found that both supervision and regulation played a role in contributing to a reduced resiliency at the bank, and we'll be looking at both.
Yeah, but the point is here, and I don't mean to bat you around on this, it's just a matter of fact. I think regulation needs to fit the risk. I think when 2155 was put up, it was put up with the idea that if you had a risky portfolio, regardless of size, that the Fed and the other agencies had the ability to tailor those to whatever threat that those risky business dealings done, right?
Senator, I agree. We're not seeking any change in law from this committee.
Okay.
We believe we have ample authority under existing law to provide a better approach to supervision and regulation going forward, and I am committed to doing that.
So one of my main concerns, and it was one of the things we talked about several years ago, is that I come from a rural state. You know this. I mean, I don't need to tell you guys what's going on here. You guys deal with rural areas, state, we don't have, I mean, there ain't a lot of banks every other block. It ain't walking down the street in LA or New York City, okay? And my concern is that these community banks that don't have a risky portfolio will end up paying the price for a CEO, by the way, that told this committee a couple days ago that they took care of all the problems, and you just pointed out that they had 31 of them that they didn't. So how do you protect the folks who are doing an honest job, providing capital, supporting agriculture, supporting Main Street businesses, supporting working families? How do you protect those? Because in 2008, I stood up here along with Brown and others, and we railed on regulators. We railed and railed and railed because they didn't do their job. And you know what they ended up doing? They end up regulating the hell out of the banking industry to the point where we made the bigger banks bigger. Talk to me.
I agree with you, Senator. It's absolutely vital that we have a strong and vibrant community banking and regional banking sector as we do today. Community banks around the country and in states all over the country are serving their communities well, and we're highly attentive to that when we think about new approaches here. The kinds of rules that I'm talking about are for large banks, not community banks.
Okay, I just want to make sure that doesn't bleed down, okay? Marty, just one last thing with the chairman's indulgence. Senator Rounds brought up some very good points on a president of a bank who may not have acted appropriately and tried to pad his own pocket. I'm not making that accusation, but as you do your research, I hope you hold them accountable. It sets a very bad form if you don't.
Understand, Senator.
Senator Kramer's recognized.
Thank you, Mr.
North
Chairman.
Dakota.
Thank you, Mr. Chairman. Thank you to all of the witnesses. Frankly, I love the temperature in here. I don't think there's any question that while we aren't all exactly in the same place, we do share two concerns. One, that supervisors didn't do enough, and two, managers did the wrong thing. So I was a soccer referee before I took up this other crazy job. And when I would do particularly collegiate men, if I didn't pull out my yellow card at the first reckless act, that was like a license for them to go crazy. But when I did put up my yellow card with the first reckless act, everybody on the pitch knew that if somebody else did it, or if they did it again, it could be a red card. If I warned them gently, they often just kept playing rough. More rules and regulations without appropriate regulating will get us nowhere. But we could beat this to death, I suppose. But I do have something that we haven't talked about that I want to ask about. What role, or maybe a better way to put it would be, what if there hadn't been a run on SVB? What if everything was the same? We know they did some things, made some sales that raised some concerns legitimately. But what if there hadn't been a social media sort of pitch that caused this run? Would we even be here today? Is it possible that nothing would have ever happened, and had there not been this sort of panic, fear? Fear is a real deal. And maybe start with you, Mr. Barr, on that. Am I crazy to think that maybe this wouldn't have even happened?
Senator, it's obviously difficult to know in any circumstance what shock is going to come to the financial system. What we focus on as supervisors when we're doing our jobs right are the vulnerabilities that a firm faces, and making sure that the firm is addressing those vulnerabilities and making sure we have resilience in the system with good rules on capital and liquidity, so that if there's a shock that nobody anticipates, they're not hit in a way that causes contagion in the financial system. So I take your point very much.
I agree with all of that. I just worried that in today's social media world that fear and panic gets accelerated, gets elevated, and highlighted. And I don't know what we're going to do about it, but interested in your view on it. One other thing I want to ask Mr. Gruenberg and Mr. Hsu maybe could comment on this. There's been a lot of talk about the sale, of the assets, the sale of First Republic to J.P. Morgan. Speaking of big getting bigger, the irony is rich. The lack of transparency in that, could each of you sort of tell me, I know the bid price is the big thing, right? That's the easy go-to in an auction. But is there more to it? Should we have considered other factors in approving that sale when there were other bidders? Start with you, Mr. Gruenberg, and then Mr. Hsu. I know you both play a role in that.
Thank you, Senator. The statute under which the FDIC works in these matters is clear, and that really gives us one factor to consider, which is least cost. And that was the only factor we were allowed to consider under the law in reviewing the bids that we received for First Republic.
So does the OCC have additional leeway with regard to the soundness of the system that could be considered?
So the factors that we're subject to are laid out by the Bank Merger Act. And those statutory factors relate to competition, convenience and needs of the community, financial stability, BSA AML, managerial financial resources, et cetera. We also have guidelines that we've released that articulate the frameworks for reviewing those. In a failing bank case, especially where there's a larger institution, we also have to take into account the financial stability factor becomes quite important. And it's very important for us to ensure that the actions we take ensure coordinated and timely government action, support minimal cost to the diff, and really check the risk of contagion and uncertainty. Those are very important.
Timeliness in a crisis is critical, and I understand that as well. I just hope the right incentives are in place. Since I have a few seconds, I just want to wrap up with what Senator Vance was talking about, Mr. Barr. You kept saying that the report finds that the supervisors were focused on the right things, but not forceful enough, sort of in regarding their findings. Or focus and forcefulness sort of go together in my mind. If they're focused, that implies exactly that, focus, but it also would imply that you'd have a forceful response. I think there is a distraction. I think it's impossible to say in the course of an 8 or 9 or 10-hour day, 40, 50-hour week with limited resources that you can just do all things intellectually, socially, culturally. It'd be better if regulators focused on the thing that they're supposed to focus on. All three of you have articulated your parameters very, very well. Let's stay within the parameters and focus there. Thank you, Mr. Chairman.
Senator Warner from Virginia is recognized.
Well, thank you, Mr. Chairman. I had a really good question that I was actually going to say something nice about my friend Senator Kennedy, but and maybe I'll get to it. But I want to pick up where Senator Kramer started, which was, no, don't worry, I may still talk about you later. You know, if the chairman gives me a little discretion. But I think what you mentioned, we can talk about how we got here and what standard was appropriate, what the regulators did right or wrong. And I was going to compliment Senator Kennedy on how he described the quality of the management at these institutions. But in the case of SVB, $42 billion in 6 hours on that run, I don't know what regulatory structure. At that point, at least on calculations I saw, that was the equivalent of 25 cents in every dollar. Nothing would have stopped that. And I don't think we've really, and frankly, Vice Chair Barr, I give you a lot of credit for your report. You had a short period of time. I think you did a good piece of work. I've got a couple of follow-up questions. But this run, and I'm going to ask to start with Michael and Marty, but I welcome everyone. But I ask this more focused to my Republican colleagues. You know, there were laws back in the 30s that if you accelerated a bank run, there was a penalty paid. Candidly, I think some of the folks from my old industry, the old venture industry, very irresponsibly, the Wednesday night before the run, exacerbated that. And they were as familiar with the institution as any entities around there. And I still would like to know where some of that money ended up going. But we've not really talked about that. We've not really talked as well. And this is where I may get the nods to go and no. I know you guys feel that the SEC leadership has got too many items on our docket at this point. But one that's not gotten a lot of attention is a fulsome look at short selling. You know, I think back in the 2008 crisis, then SEC Chair, Republican, former House Member Cox, put a hold for a couple of weeks on short selling. Later analysis showed it didn't really work that much. But maybe a fulsome look to your analogy about if your short sellers inappropriately not disclosed, that's going to not get you a yellow card. It may get you a red card. Might be something that we could collaborate on. I want to start with Mr. Gruenberg. You know, this internet-driven run exacerbated by folks who are very familiar with the institution, you know, shout and fire in a crowded theater on that Wednesday night into Thursday morning. Tools we've got, suggestions.
It is an area that I think is worth exploring. You know, the speed of that run, the ferocity of that run was something that I don't think anybody had ever seen. As you pointed out, $42 billion in a few hours, another $100 billion lined up the next day. So in less than 24 hours, you know, losing basically 85% of the deposit base is unprecedented. I do think that, you know, it's worth looking at that in relation to our banking tools, that the issues that you raise with respect to other actors is really an SEC matter.
Artie?
Senator, I think we learned some hard lessons about liquidity risk in this episode. And there are probably three things I'd point to. One, not only the reliance of the institution on uninsured deposits, but those uninsured deposits were concentrated in particular among a relatively small number of depositors. So the ability for those deposits to go fast, well, I think was really underappreciated. Second, obviously, online banking facilitates that kind of liquidity risk significantly. And the factor, as you suggested, of social media can broadcast that out much more quickly than in the past. And this is a set of realities that we're really going to have to come to grips with going forward. We issued a report on deposit insurance, and we talked about those things as matters we're going to need to work on going forward.
Anybody else on the panel want to weigh in on this?
Senator, I think you've highlighted an important issue that we need to focus on. The good news is we have in the past, liquidity risks do change over time, and we do need to be responsive to those changes. There have been examples in the past in wholesale funding markets where we have made adjustments to catch up and make sure that we can address those in a safe and sound manner.
Yeah, I just, candidly, I appreciate what everybody said, but we've all said this, but I haven't heard of that many worthwhile policy recommendations. You know, I don't think we're going to put in place the kind of speed bumps on taking money out that we've got in the stock market. I do think if we put a little bit more to Senator Kramer's position about a yellow or red card on short selling inappropriately, that might put some hesitancy there. But I do think we have to look at, is there any responsibility, particularly for somebody who's been a long-term positioner of capital in these institutions, that does this, and SVB's model was so focused on VC, they pulled the ripcord, but I would ask you all to think about this. My time has expired. I just want to make one last quick comment, Mr. Chairman. If I'd had another question, I would have asked Vice Chairman Barr, you put a lot of recommendations saying it's going to take you a couple years for the regulators. I don't think we can wait that long. I think particularly when so many of us at least think this was we all said banking 101 mismatch, making sure that information gets higher prioritized and to the management, to the board. I think there's work we need to do there, and I look forward to working with you on it. Thank you, Mr. Chairman.
What about the Kennedy compliment?
The Kennedy compliment was going to be, I was going to talk about how the executive said they'd done everything, they loved their institutions, they were so smart, and you and that kind of...
Senator's time's expired, Senator.
Why way always said to them, you called them out for being just
Senator Brett of Alabama.
over the top.
You're a fine American, Senator.
This is 1 minute off your time, Senator Kennedy. Senator Brett, Alabama.
Thank you, Mr. Chairman. I appreciate all of you being here today. On Tuesday, we heard from the top executives of SVB and Signature Bank, and unfortunately, it was disheartening to hear the lack of responsibility taken from these individuals regarding the decisions they made that put their financial institutions, their depositors, their broader banking sector across the nation in a position of unfathomable risk. I have significant concerns around their actions, but today we are here to talk about yours. I was disappointed when I read the report, Mr. Barr, the Barr report that you put out, because in my opinion, in reading that, you didn't take adequate responsibility for what I believe is under your purview. I read and saw where there was blame placed on the San Francisco Fed, where there was blame placed on your examiners, blame on your predecessors, blame on 2155, but I didn't hear the blame being put on yourself. That's the one entity or person that I didn't see in the report. I will say I really appreciate your candor today and saying that the buck stops with you. I believe that you have to take some personal responsibility for what you've done, and I appreciate you doing that today. I will say, Mr. Barr, on the day that SVB failed, how long had you been in your current role?
I joined in middle of July of 2022.
Okay, so about About 10 months?
I haven't done the math. It
Okay.
sounds like 7 months.
Okay, 7 months, 10 months to today. That makes sense. So in that short time, the ranking member mentioned this. Obviously, Mr. Vance, Senator Vance mentioned this as well, but you spent considerable time, speeches and other things, talking about climate issues and a number of those remarks. And what I fear is that we're seeing a shift of priority, a shift where someone like you, who, as I looked on your website, it says that your job is to promote the safety and soundness of the banking system, to foster stability in the financial markets, and ensure individual banks are complying with laws and regulation under its jurisdiction. The focus is not there. The focus needs to be on the 31 outstanding outstanding supervisory findings, and making sure that we have proper answers on those, not on climate risk or changes, but on what your actual job is. And so on that note, well, you mentioned earlier that the day that SVB failed, there were 31 supervisory findings that were outstanding. Is that correct?
Yes.
And so of those, my question is why your people didn't do more. It is my understanding they could have downgraded their supervisory ratings, which obviously would have resulted in more frequent supervision and exams, or they could have taken enforcement actions like prohibiting dividends to shareholders, requiring immediate capital increases, fines, other things like that, but they did neither. Is that correct?
The supervisors had downgraded the firm in the summer with respect to broad-based problems in governance and controls, risk management functions, to deficient 1, which means the firm is not well managed. And as a result of that, the firm was subject to a 4M limitation, which meant that it could no longer merge with or acquire non-banking entities. And the staff were also in the process of developing a detailed memorandum of understanding, which is the first level enforcement action after a deficient downgrade occurs. So the steps were in train. What the report found is that our supervisors were not moving fast enough with respect to those actions.
So they had the tools in their toolbox, but they weren't using them with the force that they could have.
Yes, I think it's fair to say that the tools were there.
The tools were there. They just they didn't use them with the force. I'm hoping moving forward, I don't think we need new tools. I just think to your earlier point about creating a culture where those tools are used, you can do that internally. That's a leadership issue. That's not something that we don't need more rules or regulations to do that. And I am almost out of time. Mr. Gruenberg, my question is for you. Do you agree that if Silicon Valley Bank was sold while it was still an open bank, it would have been better for the economy, the consumers, and other banks who have now had to foot the bill to replenish the diff?
Yes, Senator.
Okay, so did you have any interested parties with interest to purchase SVB the night before SVB failed?
I'm not aware of any, Senator. We weren't the primary regulator, so we wouldn't have been the ones necessarily contacted in regard to that.
Okay, but if there were interested parties and we find that there were, that certainly should have been done the night before versus afterwards, it would have saved us all $35 billion at this point.
If there were opportunities for an open institution solution, that would have been preferable.
Well, if we find that, I certainly hope that in the future we make those types of choices instead of ones that ultimately cause institutions all over the country to have to pay. Thank you.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So earlier this month, when First Republic Bank collapsed, multiple banks were interested in buying the failed bank. Banking regulators chose JP Morgan Chase, America's biggest bank. The result was that a gigantic, poorly supervised bank was swallowed up by an even more gigantic bank, and now the biggest bank in the country is about $200 billion bigger than it was before. So in order for the deal to go through, two separate regulators had to sign off. When the FDIC sells a failed bank, the law requires it to choose the highest bidder that will result in the lowest cost to the deposit insurance fund. But the law also requires sign-off from the OCC. And the OCC's job, by law, is to consider whether the merger would pose, quote, risk to the stability of the United States banking or financial system, end quote. Acting Controller Hsu, OCC regulations include a list of factors that the OCC must consider when evaluating, quote, risk to the stability of the banking system. Do you know the first item on that list?
It relates to the financial stability, whether there's a threat to financial stability in the U.S.
Whether or not, and what is the item you're supposed to consider? The very first one on the list.
I believe it is whether the merger will have financial stability impacts.
Because of?
Because of the merger.
No, it's whether the proposed transaction would result in a material increase in risks to the financial stability due to an increase in the size of the combining institutions. It troubles me that you don't remember this. So how do we know if a purchasing bank poses more or less risk to the banking system? Well, one metric that regulators use is the GSIB score, which estimates the impact on our financial system of the failure of each of our largest banks. The size of the bank is a big factor in its GSIB score. So let's look at the GSIB scores and figure out if JP Morgan, according to the OCC's own analysis, presented more risk to the banking system than the other bidders that have been widely reported in the press. So PNC tried to buy the failing bank, but you approved JP Morgan instead. Acting Controller Hsu, is the GSIB score for JP Morgan bigger than the equivalent score for PNC?
It is.
How much bigger?
I don't know the exact magnitude of it off the top of my head.
Do you want to make a guess?
It's bigger.
8 times bigger, does that sound right? Yeah. Let's take a look at another bidder, Citizens Bank. Is JP Morgan's GSIB score, that is the score that shows risk to the banking system, bigger than the score for Citizens Bank?
It is.
How much bigger?
Significantly bigger.
14 times bigger?
Perhaps. I don't know the exact scores in front of me.
Controller Hsu, your job by law is to determine risk to the system from making big banks even bigger. And you have a clear metric for doing that, the GSIB scores. So how do you explain approving a sale to a banking giant that increases the risk to the banking system by somewhere between nearly 800% and 1,400% more than selling to other bidders? Did you just ignore the fact that a failure at JP Morgan would blow a hole in our banking system that would be 8 times more than the destruction to the financial system and let them grow by $200 billion?
Senator Warren, for every merger application, we follow the law, we follow our guidelines, we follow our policies and procedures. Under the financial stability prong of the Bank Merger Act, there are a number of factors. You named one. Had we followed a strict GSIB score methodology to the exclusion of everything else, I fear that there would have been greater financial instability that weekend. When we make these decisions, I have to take into account a range of factors, including.
So if I can, I know I'm nearly out of time, but if the chairman will let me pursue for just a minute here. Are you telling me that there are other factors that weighed against the other bidders that weren't there for JP Morgan Chase, and that's how it is that you went with the biggest bidder, even though the biggest bidder, by your own GSIB scores, increases risk to the financial system?
What I'm saying is that a GSIB score approach to that factor that weekend would not have been a wise one.
Because that's why we're here to exercise oversight. You can't just say, I decided on something else without putting some facts behind that.
The GSIB score framework is not part of the framework that is listed there. There's a number of factors there. We're taking into what's very important, especially when there's a failing bank situation, is that the government act in a coordinated and timely manner, that we minimize losses to the TIF.
You
and that
had,
the risk of
you had one
contagion-
job to do, and I appreciate, I'm
No,
out of
sir, yes,
town
sir.
here, time here, and I appreciate your forbearance here, Mr. Chairman, but I do want to say, the single biggest threat to the U.S. banking system is concentration. We're all pushing harder for merger guidelines so that we don't get more concentration in the banking system. You are the one person who was supposed to use judgment on the question of, as between multiple sales, which one was the right one to go with and which one presented more risk to the banking system. According to your own metric, you chose the one that gives us more concentration in the system. I am very troubled by that decision.
Senator Tillis from North Carolina is recognized.
Thank you, Mr. Chairman. I wanted to start. I know Senator Tester and I sent a letter today talking about an external review. I believe that for the most part, did he ask you the question about whether or not you think an external review would be helpful?
Yes,
you
sir.
answered in the affirmative. Great. Then I look forward to us being able to move forward with that. Also, Senator Warner spoke about the fact that really no bank, even a bank that's well managed, well capitalized, could actually withstand the pressure that SVB went over in terms of deposit flight. I think what we've seen here now is maybe the narrative. There was a couple of months ago, it was all about bad management. It was all about bad supervision. Now I think what we're seeing is maybe there was a little bit of that, plus the external factors. And I hope that as we get a report, we can understand it's not as simple as some people have made it to be. And I'm looking forward to see to what extent, if any, some have said that S2155 was the root cause of the failure. I think an external review is probably going to debunk that myth that's been shared by some of my members here. But Mr. Barr, I wanted to talk with you. When we had Mr. Becker here before the committee, he mentioned that he had 31 open MRAs or MRIAs. That seems like a large number. So how is Congress supposed to view the effectiveness of Fed supervision when the Fed allows a firm to rack up those number of MRAs and MRIAs, particularly a bank whose activities and portfolio is very different from the vast majority of banks?
Senator Tillis, the MRAs and MRAs are a sign that the supervisors are attempting to hold the bank accountable. What happened in this case is it failed before it finished addressing those concerns. That kind of level of MRA and MRA is 3 times the peer average for that kind of institution. So it showed the institution had serious problems. The supervisors had downgraded their risk management to deficient, which meant the firm was not well managed. They had entered into a 4M obligation, which meant that were restrictions on their non-bank activities. And the supervisors were in the process of putting in place the first level enforcement action, a memorandum of understanding, when the bank failed.
I don't want you to respond, but I do want to we'll submit a question for the record, because I'm trying to get some sense of, it seems like some of these were issued a year earlier. If I recall, it was sometime in 2022. Is there any sort of aging or follow-up on how, particularly for matters requiring immediate attention? And how well did SVB do compared to their peers on clearing and addressing these MRAs?
They were slower than they should have been at addressing them. They were not consistent with what we see from most banks. Most banks, most of the time, respond quickly, and they're able to fix their problems quickly. And in the case of SVB, they did not fix their problems quickly, and there were serious risks in the institution with respect to interest rate risk, liquidity risk, and basic blocking and tackling of risk management.
I've spoken with a number of banks over the past couple of weeks, and I also, it seems like after SVB's failure, there has been an expansion, or I should say a dramatic increase across the industry in terms of MRAs and MRI. I don't know about MRIAs, but I do know that the typical flow of MRAs seems to have gone up industry-wide. Am I right in that trend, or have you had an opportunity to take a look at that?
Senator Tillis, it is a terrific question. I have not looked at that, but I will examine it after the hearing.
I was in a meeting with probably 20, 25 banks represented, asked for a show of hands. How many of you have seen a significant influx since the SVB failure? Every hand was raised. So I think it would be something helpful for us to see. There could be various reasons for doing that. You learn from the problems at SVB, but it seems odd that given the unique nature of SVB, that suddenly we would see this trend across the industry for a very wide variety of institutions. So reporting back to that would be helpful. We will submit some questions for the record. Thank you all for being here.
Senator Cortez Masto is recognized.
Thank you, Mr. Chairman, and thank you all for being here. Mr. Barr, let me start with you. As you've heard, we had the executives before us just a couple of days ago, and not one of them took responsibility for their actions or lack thereof of bad management, and we're basically throwing others under the bus. And just yesterday, Greg Becker, the CEO of the failed Silicon Valley Bank, testified that no Federal Reserve supervisor raised interest rate risk with him prior to the failure of SVB. What I'm hearing from you is that is not correct.
Senator, that's simply not true. I'll just give you, one example. I'll just read from this letter that the supervisor sent to Silicon Valley Bank dated November 15th. It's addressed to Mr. Greg Becker, the CEO of SVB. It begins, "Dear Mr. Becker." The first line of the executive summary says, "The firm's interest rate risk simulations are not reliable." It goes on to say, "Changes in net interest margin, net interest income, and earnings are directionally inconsistent with internal projections. Unreliable IRR modeling directly impairs management and the board's ability to make sound asset liability management decisions. It includes a matter requiring attention," and the letter says quite clearly what is the impact of this. "Unreliable IRR modeling outputs impair management and the board's ability to make important asset liability management decisions. In the firm's case, simulation results gave a false sense of safety in a rising rate environment and masked the need to take actions earlier in the rate cycle." This letter was sent to Mr. Becker on November 15th. It memorializes a conversation with Mr. Becker and other senior executives on November 14th.
Thank you. And I have a copy of that letter. And Mr. Chairman, I'd ask to submit this for the record.
Without objection, so ordered.
Can I ask you, Mr. Barr, based on that analysis, was that a cause for some individuals to do a run on the bank?
The cause ultimately of why individuals chose to run on the bank seems to be related directly to its solvency. And the solvency problem was because of poor interest rate risk management outlined in the letter.
Thank you. And isn't it true for all regulators, you're always concerned about a run on a bank? Isn't that correct? That's what you're trying to prevent, correct?
Yes, Senator.
Right. So it's nothing new other than you have social media out there now that helps to amplify and connect individuals with information just like this, which may cause a run on the bank, correct?
Yes, Senator, that is correct.
But I am concerned about this moral hazard issue because at what point do we continue to bail out individuals who should know better? It's investors who invest money in banks without the insurance, the appropriate insurance. Should they be bailed out? And I guess this is a question, Mr. Gruenberg, that I have for you. What should we be doing here?
Well, I think the weekend of the failures of Silicon Valley Bank and Signature Bank really posed, I think, a tough judgment for the agencies to make. I think our initial view when Silicon Valley Bank failed was it was a idiosyncratic failure, and we did not necessarily believe a systemic risk exception was warranted. I think when Signature Bank failed immediately following, and we got reports of serious liquidity stress at other institutions, it really became apparent that there was a contagion effect here. And I think there was a judgment made under the statute, we have.
And I get that. I only have so much time, but let me ask you this, and I think it was Mr. Hsu who said this, is that we should be looking at deposit insurance coverage, and it should be updated. Should we be looking at at this insurance coverage, and what should we be considering here?
So, the FDIC issued a comprehensive report on this. We outlined some options. The one we thought had the most promise from both a moral hazard and a financial stability standpoint would be arguably increasing coverage for business payment accounts. Those are accounts that businesses rely on. They can't really hold accounts at multiple institutions for operational reasons, so it doesn't pose the moral hazard risk. But because of the business payment function, it can have financial stability concerns. So if we're going to look at an option for adjusting deposit insurance coverage, and it would require legislation to do that, perhaps increased coverage for business payment accounts might make some sense.
Thank you. And Mr. Chairman, I'm going over my time, but one final thing that I think needs to be pointed out here. I think we're all in agreement here that there's enough blame to go around, whether it was the bad management, lack of supervision, a combination of things we have to learn from it. But one thing that is missing in all of this, and I am hearing this from others, including my bankers, the failures of First Republic, of Silicon Valley Bank, of Signature Bank, is having a direct impact in hurting families, small businesses, right? Workers, community banks. What I am hearing is that it has caused banks to reduce their lending, resulting in less credit available to individuals and businesses. Does anybody disagree with that? No. So again, this is having an impact on working families and businesses and community banks, and we have to address this. It is something we need to come together, figure out what went wrong here, prevent it from happening, but put the regulation in place, make sure that everybody who was responsible for it is held accountable, not just the regulators, but those executives as well. Thank you, Mr. Chair.
Thank you, Senator Cortez. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman. Vice Chair Barr, I'd like to start with you. The recent case study of the Fed's supervisory failures at Silicon Valley Bank frankly highlights a fundamental tension that exists between the Fed's competing priorities. Congress has given the Fed a dual mandate, of course, and monetary policy mission to target both low unemployment and stable prices. And it's a balance that evidently has been pretty difficult to manage in the current environment where rates have been driven so high so fast given the massive inflation that we've incurred during this administration. The primary mandate of monetary policy, however, also highlights an inherent tension with your supervision responsibilities. And I understand there's a firewall between monetary policy and supervision at the Fed, and there undoubtedly should be. But this conflict seems to be more pronounced than ever, because the Fed raises rates, which then creates bank solvency risks that relates to your supervisory role. So, Vice Chair Barr, how can someone in your role objectively vote to raise interest rates to advance the Fed's important inflation mandate, while also serving as prudential supervisor of bank safety, which obviously also will be impacted by your interest rate decisions? Is there an inherent conflict here?
Senator, I don't believe there's an inherent conflict in either roles, and I think it's important that when we're engaged in monetary policy, we're focused on our job at the Fed, at the FOMC, which is price stability consistent with maximum employment. And that's what we've been doing, and I've voted to do that in each instance. So that's our job. Our job is to understand.
You also wear a second hat, though, and that second hat is supervisory role. And they're two completely different functions. I won't take more time with it now, except to say it's something I think that we ought to take a hard look at. This potential conflict is a dynamic that I think requires more consideration here among our colleagues in Congress. Chair Gruenberg, I want to turn to you. On Tuesday, in front of the Banking Committee here, former SVB CEO Greg Becker said that he tried to assist the FDIC in navigating SVB's balance sheet and facilitating a sale, but his efforts were rebuffed. First, I want to know if this is true. And then second, if that's so, why would the FDIC not enlist the help of somebody that would have been intimately familiar with the balance sheet, be able to perhaps better position the assets for sale and perhaps reduce the cost to the American taxpayer?
Senator, thank you for the question. It's my understanding that FDIC staff actually did meet with Mr. Becker on, I believe it was the Saturday, get input from him on the condition.
Interesting. That's contrary to what he said.
No, I'm just reporting the information I have. And to get information from him on the institution, as well as got input from him on potential acquirers.
Yeah, we'll need to get to the bottom of this conflict then. Very interesting. A different point, something that is deeply concerning to me and has come out with many, many bankers that I've spoken with now, and that's regard to our posture on mergers and acquisitions in the banking sector. As you know, last year the FDIC sent a request for information about bank mergers. And a request for information sounds benign, but when you look at what was imbued in this request, it was full of ideological opposition to the concept of mergers. You think about it from the heavy emphasis on the so-called financial stability factor to this President's executive order across all agencies on consolidation. The reductionist posture that the FDIC has taken on bank mergers is quite troubling to me. And the market certainly recognizes your agency's ideological position. If you just look at First Republic, it was clear that this bank was under major duress in the weeks leading up to its failure, yet no buyer emerged. I don't think it's a controversial opinion to state that America would have been much better off had a buyer first purchased First Republic rather than waiting until the bank was taken into receivership, leaving the American taxpayer to pick up a tab to the tune of $13 billion, and that's not to mention the $22 billion the FDIC had already taken from the DIF in March. But if you think about the market's perception of regulators' positions on M&A, it's not surprising to me that no acquisition took place. So I want to ask you, in light of your comments to Senator Britt and where we are today, do you agree that an acquisition or merger before a bank fails is better for the system and better for the American taxpayer?
Yes, I do, Senator.
And if so, the stance of the FDIC has changed in regards to the benefits of mergers and acquisitions in the banking sector. Could you update me on the status and the time frame of the FDIC's merger guidance?
We are undertaking a review of the Bank Merger Act. There has not been a review, as you may know, for 25 years. We're doing it in conjunction with the other bank regulatory agencies and with the Justice Department, which, as you know, also has a statutory role under the Bank Merger Act. And from my standpoint,
I think I'm out of time, but I think it's important to note that you are in agreement that a merger and acquisition before a failure is a better outcome for the American taxpayer. I hope that that will be very clear in your review, and I hope that we'll see that manifest because the banking community, the industry needs to get this sort of certainty. Thank you, Mr. Chairman.
Thanks, sir. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Thank all of you for your testimony here today. And Mr. Chairman, I'd ask unanimous consent to put in the record a Financial Times article, which I included in the hearing the other day as well, entitled "Executive Pay at Silicon Valley Bank Soared After Big Bet on Riskier Assets."
Without objection, so ordered.
And Mr. Chairman, I also ask unanimous consent to put in an article entitled "Silicon Valley Bank Execs Enjoyed Generous Compensation in Recent Years with CEO and CFO Packages Up to 30% from 2018."
Without objection, so ordered.
Thank you. Now, Mr. Barr, I'm looking at the report that you and your team did on Silicon Valley Bank, and on page 74, you have a section entitled "Coverage of Incentive Compensation" at SVB-FG. And it reads in part here, "Supervisors concluded that the bank's incentive compensation decisions were primarily based on their financial performance with minimal to no linkage to risk management and control factors." You go on to say that risk management deficiencies identified by independent risk factors or through regulatory examinations have not been meaningfully considered by SVB-FG's incentive compensation decisions. And it goes on to point out that they goosed their profits in order to get their return on investment up. Reading your explanation, it's an anodyne version of what the Financial Times says pretty bluntly, which is that they manipulated their profits in a way that increased their risks and had no compensation tied to the fact that they were increasing risk. So the bottom line, as I see this in their compensation structure, they profited by taking a lot more risk. Is that your conclusion?
Yes, Senator. The supervisors found that the way the board structured compensation for the firm, it did not include any appropriate risk management. That was one of the reasons why the supervisors downgraded the firm's governance and controls to deficient. The firm was not well managed, and they did not have a compensation scheme that was appropriately taking risk into account. And as you suggest, in several instances, they chose to take actions that expose themselves to more risk because those increased profits. For example, they took off interest rate risk hedges in March through July of 2022 at a time when interest rates were rising rapidly. Instead of protecting themselves from that interest rate risk increase, they took the profit from selling the hedges.
Well, exactly. They made a decision to boost their bonuses by taking measures to boost their profits that added a lot of risk to everybody else. And, you know, this would be one thing if you had a private enterprise where the only people who are on the hook here were the executives and their shareholders. But in this case, you have all the depositors that are at risk, and the FDIC came in with public money. So do you agree that we need to better align executive compensation rules and packages for banks that are FDIC insured with the risks that are being taken? In other words, do you agree that we need to take a much better look at what we should allow or not allow, and that we should not allow executives to be getting these big bonuses and through their own negligence then seeing their banks collapse? Do you agree with that proposition?
Yes, Senator, I think we need to take a good hard look at that, and the agencies are working together on a rulemaking under the Dodd-Frank Act with respect to that.
Right. So I think you're referring to Dodd-Frank 956 rules. So I would just urge you by the end of the year to get this done. Congresswoman Nydia Velázquez and I sent you all a letter with some very clear ideas for how we can better tie compensation to safety and soundness and not have the kind of situation we have here today. It's outrageous. I hope we will find a way to claw back compensation in these kind of situations that we've experienced to date, but even better, to prevent it from happening again, where people see CEOs and executives walking out with these huge bonuses weeks before their banks collapse and the FDIC and the public has to come in to support the depositors. So I just hope we'll look at this as a big part of the reform effort. Thank you, Mr. Chairman.
Senator Kennedy of Louisiana.
I want to thank the chairman for this hearing. It should not go unnoticed, though, that some of our banks in America under your supervision are hanging by a thread. Some of them have failed, and there are 6 of you, and we only have 5 minutes to talk to you. So I'm hoping our chairman will have another hearing and give us all more time. It also should not go unnoticed, it seems to me, I don't think it does to the American people, that when someone in the federal government gets it wrong, no one is ever fired. I mean, I've listened to this testimony today, and I get the impression how can I put this? If Elizabeth Holmes worked for one of your agencies, she'd probably be getting a bonus. Chairman Barr, for whom I have great respect, I have read your report. I've listened to your testimony. I have followed your remarks in the media. And here's what I hear you saying. My people and I at my agency did not do a good job. And therefore, Congress should give us more money and power. Is that about right?
Senator, I am not seeking any additional authority or power or money from this committee.
But you're going to promulgate new rules to give you and your people more power, are you not?
We're going to use our existing authority to strengthen supervision and regulation to make it less likely that this kind of event happens in the future. I'm committed to fixing our system of supervision, making it more agile, making it more forceful, making it quicker, and getting the right rules in place so we have good rules of the road. I'm absolutely committed to getting that done.
Okay, well, let me rephrase my question here's what I hear you saying. My people and I did not do a good job, and therefore we're going to take the steps to make sure that we get more money and power. Is that more accurate?
We're not asking for more money or more power. We're asking to we're not asking really for anything. We're committing to getting our system of supervision and regulation right, and we'll do that now.
Well, here's what else I hear you saying, Mr. Chairman. I hear you saying, my people and I screwed up. But even though we're adults with free will and responsibility, it wasn't our fault. Because Trump ate our homework. I mean, I looked at your report. And to be more specific, Randy Quarles ate our homework. I mean, you said in your report, you talked about Trump-era changes, and you say those changes, quote, impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach, end quote. So I find your acceptance of responsibility in light of your report to be a bit hollow. The way I read your report, let me say it again, you're saying, yep, we screwed up, but it's not our fault because Trump ate our homework. Is that about right?
Senator, I disagree with that characterization. First of all, the report does not speak about any politician.
Is Randy Quarles at fault?
I accept full responsibility for our supervision and regulation at the Federal Reserve.
You didn't in your report.
And the report does as well. The report is
No, it doesn't.
absolutely clear about that.
No, it doesn't.
We
I just
accept
read from your
responsibility.
report. No, it doesn't. Did I read it wrong?
I believe you did, sir.
No, it didn't. Here it is, bigger than Dallas. Go back and read your own report. I yield back my 4 seconds, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Chair Brown and Ranking Member, and thanks to all of you for being here today. Let me just follow up a little bit. Mr. Barr, I really appreciated the candid appraisal that you provided, that the Fed provided in your review of what happened with these banks. And part of what I took from your appraisal was that decisions made and actions taken prior to you being at the Fed had a distinct impact on the ways in which regulations were enforced and supervision was deployed. Do I have that right?
Yes, that was one of the findings of the report, is that the 2019 tailoring rules contributed to lower supervisory standards with respect to firms like SVB.
Right.
Including lower capital requirements, lower liquidity requirements, less stringent supervision, and other measures.
And I think that's just the reality. And, you know, we are in the business of trying to figure out how to fix these problems. And I appreciate the tone with which you approach this discussion, which is to be kind of on the side of solving problems and not just identifying problems. And so I just want to thank you for that. This gets to kind of the thing that I want to follow up on a little bit. You know, some of you have heard in this committee that I come from a family of community bankers. My grandmother was a president of a small community bank back in the 1940s and 50s and 60s. And I remember when I was a little kid, the frisson that would go through the bank when the bank examiners were coming to town. It was a big deal. And you didn't just ignore the examiners, you listened to what they had to say, and if they saw a problem, you fixed it. And I suspect that the hundreds of community banks in Minnesota would say exactly the same thing in 2023. So, what I'm struck by is I think about what happened at Silicon Valley Bank, how they didn't have adequate interest and liquidity risk policies in place. The board wasn't fully aware, it appears, of the exposure of the bank as interest rates rose. Management wasn't held accountable. In fact, as Senator Van Hollen was just identifying, management appeared to be rewarded for taking additional risk. And so I'm just so struck by the lack of urgency. Why was it that these executives seemed to think that the guidance, the deficiency ratings that they were getting were just like another thing that happened as opposed to the thing you just ran around town and fixed as quickly as you could?
Senator, I think you raise an absolutely critical point. And like you, my experience has been most banks all over the country, community banks, regional banks, they first of all, don't get themselves into these difficulties by and large.
Right.
And if they do get themselves into some difficulty, they are very focused on responding promptly to supervisors, to examiners' concerns. And in this instance, that is not the case. The bank took far too long to respond in appropriate ways. And as I said earlier, in some cases, went in the opposite direction. They kind of changed the test. When the test resulted in them failing the test, they tried to change the test to make it less conservative on interest rate risk, on liquidity risk. That's not a sign of a firm engaging in appropriate behavior.
Right.
They took off interest rate hedges that would have helped them have more resiliency in order to boost short-term profit. That's not a sign that they're taking these measures seriously.
And I appreciated in your in the reports that you identify the need for the Fed supervisors to bring more, as you say, agility and forcefulness to the to this process. Because as I think about my grandmother's community bank, there was no question that if they didn't follow through, there was going to be accountability, and that's what seems to be missing here. There just seemed to be no sense that there was going to be accountability if these executives didn't do what they were being asked to do.
Senator, I agree. Senator Kramer earlier used the analogy of the yellow card. I think
Right.
a lot of yellow cards were issued, but not enough red cards.
Right, exactly. Well, to me, that is the avenue that we really need to look at, both from the question of accountability for the bank, but also accountability for the supervisors to bring that level of, as you say, forcefulness, and also to look at the additional changes that might be necessary to rules. So I appreciate that very much. Mr. Chair, I know I'm out of time, but what I will do is I will follow up separately with you, Mr. Gruenberg, on the issue of the approach that you're recommending, that the FDIC is recommending around special assessments to replenish the deposit insurance fund. This is, of course, a matter of great interest to Minnesota community banks as they think about replenishing a pool of money that they had no role in diminishing. Thank you.
Thanks, Senator. Senator Sinema from Arizona is recognized.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. The Federal Reserve's recent report is crystal clear. Despite what you may hear from some in Washington, the Fed knew Silicon Valley Bank was in trouble, had all the tools to fix it, and failed to respond in time. Furthermore, the FDIC's recent self-assessment on how Signature Bank failed on its watch was deeply alarming. I'm particularly concerned about the acute shortage of bank examiners at the FDIC. Chair Gruenberg, Vice Chair Barr, I have questions for both of you today, but since I have several and limited time, please keep your answers concise and specific to 20 seconds. I will interrupt to keep things going if needed, and we can follow up if we need to. So first, for Chair Gruenberg, let's start there. My understanding is that examiner staffing is measured in hours, and that the New York region, where Signature was based, particularly struggles to recruit and retain qualified bank examiners. If the FDIC's New York region is understaffed, this may not be an isolated incident. Are you confident that other banks in the region are being adequately supervised and examined?
I believe they are, Senator.
Since you are able to set your own budget, I'd like to know what you're doing to fix the issue in New York and in other regions where it exists. I believe your staff is briefing my staff on this issue. I look forward to following up after the briefing. Now, Vice Chair Barr, it's good to see you. I was pleased to see you acknowledge the need for cultural and operational changes at the Fed, but the report was light on details. I recognize you're on a tight deadline, but now that the report is public, it's time to get specific with our goals, roll up our sleeves, and get to work. With respect to cultural and operational changes at the Federal Reserve, how are you defining success?
I think we need to have a workforce that's agile, that acts quickly and acts forcefully to prevent these kinds of problems in the future.
And how fast will you achieve that?
I think it will take time. I think cultural change is difficult, but I've started that work already and I'm committed to getting it done.
But you have no timeline.
I do not currently have a timeline. That's the next step in the process after the SVB report was released, was to develop detailed work plans.
And I think that's what we need, are specific metrics, rather than just a focus on outcomes, which say more about a business cycle. What we're interested in is a well-designed regulatory process. So here's a metric. Turnaround time is a problem at the Federal Reserve. The examiners found serious problems at Silicon Valley Bank, but the regulators were fatally late in responding. So following an examination finding, what is the median turnaround time for a Fed regulatory response?
Senator, I would say the bank was fatally late in responding to the supervisor's concerns. And when they were late, the supervisors did not escalate fast enough. The timing depends on the precise nature of the findings, so I can't give you an answer that would be generalizable.
Well, I understand you don't have an answer today, and that's all right. But I would like to get a more specific answer. More importantly, I'd like to know what you'd like the answer to be. Is it the answer, what will it be a year from now? What will the answer be 3 years from now? What will the answer be 5 years from now? Bank runs are happening faster than ever, and we need regulatory processes that can operate at the speed of business. In your last appearance before this committee, you and I spoke about how sometimes the length was 6 weeks between times of communication, including sending the communication through mail. We don't really live in that kind of a slow world anymore. When a bank run can occur in 4 hours, we probably should stop communicating over snail mail. So I recognize that the Fed must balance the need to be responsive with its historically deliberative approach to complex issues. So have you identified other metrics that will be used to measure success when enacting lasting cultural and operational change? And if so, what are those metrics?
As I said, Senator, the next phase in the process is to develop detailed work plans, and for each of those work plans, there will be metrics, but I don't have those for you today.
You don't even have general guidelines around what the metrics could be?
The three things, as I said, that we're most focused on in terms of supervision are increasing the agility of our workforce, increasing the speed of action, and increasing the forcefulness of action. And those will be, at a high level, the things that we're going to be looking for.
Thank you. So a couple quick questions for you. Who is leading this process of transformation work at the Fed?
I am responsible for it.
And are you delegating it?
I am responsible for it. I will, of course, have a large team of people who are working with me to get that done.
And will there be staff at the Fed working full-time on this issue? Or is this something where you'll be retaining consulting services to help you develop and execute a plan?
We'll both be using internal staff as well as external supports, including consulting services, to do that.
And as you're funded independently of Congress, how much budget are you allocating for this work and for how long?
We have not detailed a detailed budget plan at this time. As I said, that would be the next phase of the project, is to develop those detailed work plans, to find the appropriate staffing and make sure we have the resources that are charged against that task.
And Vice Chair Barr, as you develop that plan, will you commit to releasing that plan to the American public and to members of this committee, including specific measurable goals, so that we can determine if your efforts have been successful in achieving these cultural and operational changes?
I would be happy to come back up to the committee, of course, at any time.
Would you be willing to commit to a quarterly basis of reporting to this committee?
I'd be happy to work with your office to find the appropriate timing and pacing of coming back to discuss this with you and the committee.
Thank you, Vice Chair. The next time we meet, I expect greater specificity from you and reports of progress that we've made in these areas. I appreciate your work, and I thank you for your service. Thank you, Mr. Chair.
Thanks, Senator Sinema. This concludes the hearing. We all seem to agree that supervisors need to hold banks accountable to the rules that are supposed to keep our banking system safe. I think Senator Sinema's questions were right on that way. We know that as banks grew too much, too fast, starting in 2019, no one else held up the yellow card that Senator Kramer said they should have. In fact, Congress, President Trump, and former regulators gave them a green light. The basic rules of the game made it so that banks like SVB had weaker capital and liquidity standards, had too much time to transition to tougher rules. Now we need to strengthen those guardrails and the culture of supervision so that banks have clear rules and expectations, and when they are not met, regulators are empowered to crack down quickly. We expect that, especially from you, Vice Chair Barr. One of the more troubling aspects of the events of the last couple months is that it shows what many of us knew all along, that trillion-dollar banks aren't the only institution that are too big to fail. That's why we need to make sure that banks like SVB and Signature and First Republic are held to higher standards so that we can protect the financial stability of the entire banking system and make sure that banks and credit unions of all sizes can continue to serve their communities and the public. Again, thanks to the 6 of you. For senators who wish to submit questions, those questions are due 1 week from today on Thursday, May 25th. Witnesses, please submit your responses to those questions for the record 45 days, no more than 45 days from the day you receive them. Thank you again for joining us. Thank you all for your public service. Committee's adjourned.